The market cipher here. Silver just crashed 40% in 4 days. The worst single-day drop since March 1980. Price collapsed from an all-time high of 121.67 to an intraday low of $72.73. Over 180 billion erased from total silver market cap in one single week. Let me say that again. 180 billion gone in 7 days. Then something unexpected happened. Silver bounced 16% off that low and is currently trading at $84.34. Gold is holding above $550 after its own violent correction. Oil just spiked to $90.90 on escalating geopolitical risk in the Middle East, the biggest single-day percentage gain in months. And what happened during that silver crash should have every single person watching this pay very close attention. Because the paper market told one story. The physical market told the complete opposite story. Two markets, two completely different realities, same metal, one of them is lying. And here's why I say you should be paying attention. Because we mapped this exact move before it happened. In last week's video, we identified the $72 to $73 zone as critical support for exactly this type of liquidation event. We said if a crash came, if the paper market tried to shake out longs, that's where real buyers would step in aggressively. That's exactly where price found its floor at $72.73, not $70, not $75, exactly the zone we outlined. I shared the updates in real time. The handle is at the Market Cipher on YouTube. It's verified. It can't be duplicated. If someone else is using my name, they're a scammer. Ignore them. I don't sell courses. I don't run paid signals. I don't manage money. I don't pitch investments. Just verified data to help you think for yourself. That's what this channel is about. Independent thinking, not following the herd. Comment below with your price target for silver next week. I read every single one and I'll address the best questions in the next video. Now let me show you what actually happened during this crash, because the data tells a very different story than the price chart most people are looking at. The selling started Thursday, January 30th. That was the day CME Group announced their second margin hike in 3 weeks. They raised silver futures margins to 15% of notional value, up from 11%. Let me translate that. If you held a $500,000 silver futures position, you suddenly needed to post $75,000 in cash instead of $55,000. That's a 47% increase in the cash required to hold your position. If you didn't have the extra $20,000 lying around, your broker liquidated you. No questions asked, no mercy. Within 24 hours of that margin hike, silver collapsed 31.4% in a single session. January 31st, 2026, a Friday, the last trading day of the month, the worst single-day crash since Silver Thursday in March 1980. Let me put that in perspective. This wasn't panic from retail investors checking their Robinhood accounts. This wasn't fundamental repricing based on some new economic data release. Silver's industrial demand didn't disappear overnight. Solar panel factories didn't shut down. AI data centers didn't suddenly cancel their server orders. Electric vehicle production didn't stop. The physical world kept spinning. The physical demand kept growing. Only the paper price collapsed. This was a calculated, systematic margin squeeze, executed on the last trading day of the month, a Friday, with no ability to adjust positions over the weekend. If you got margin called on Friday afternoon, you couldn't do anything until Monday. Your position was liquidated into a falling market at the worst possible price. The timing was surgical. But the timing is suspicious for another reason. This crash began the exact same day Trump nominated Kevin Warsh as Federal Reserve Chair. Warsh is perceived as hawkish. A rate cutter he is not. The nomination collapsed rate cut expectations instantly. Treasury yields rose. The dollar strengthened. All of that created the perfect cover story for the crash. CNBC could say silver crashed because of Fed expectations. Bloomberg could blame the strong dollar. But here's the part that should make every single person watching this sit up straight. Look at what happened while the paper price was crashing. While COMEX silver crashed to $72, Shanghai silver was trading at $95. Let me say that again so it sinks in. Physical silver in China, actual metal you can hold in your hand, was trading at a $23 premium, 29% above the paper price in New York. At the peak of the divergence, the premium hit $36. That's nearly 46% above COMEX when you include China's 13% VAT on silver imports. The arbitrage was so extreme that traders were literally air freighting silver from London to Shanghai. Not shipping by sea, air freighting. Because even with the cost of cargo planes, they were making $34 per ounce profit. When was the last time you heard of anyone air freighting a commodity to capture an arbitrage? That's how desperate the physical demand was. In a real sell-off driven by genuine supply and demand, premiums collapse. Holders panic. They dump metal at any price. Physical floods the market. Premiums go negative. That's what happened in 2008. That's what happened briefly in March 2020. But this time, the exact opposite happened. Premiums exploded to the highest level ever recorded. The paper market screamed sell. The physical market screamed buy at any price. During those same 4 days, COMEX registered silver inventory dropped from 105 million ounces to 81.73 million ounces. That's 23 million ounces drained from registered vaults in just 5 weeks. Metal was leaving the system while the paper price was crashing. Someone was taking physical delivery at artificially suppressed prices while weak-handed traders were being liquidated. Think about that. While you were watching the price collapse on your screen, someone was backing up the truck and loading real silver onto pallets. The gold-silver ratio spiked from 46-1 at the January peak to 61-1 after the crash. At the peak, silver was outperforming gold. The ratio was compressing toward historic lows. Then the crash hit, and the ratio blew out again. But here's what didn't change. The mining ratio is still 1-8. For every 1 ounce of gold mined from the earth, 8 ounces of silver are mined. Yet silver is priced at 1/61st of gold's value. Does that make sense to anyone? The paper market says silver is worth $72. The physical market says $95. Which one is lying? Connect the dots. So if the physical market didn't follow the paper market down, who benefited from this crash? And why now? The timing reveals everything. The crash began the same week as the January COMEX delivery deadline. January 2026 was not a normal delivery month. 12,146 contracts stood for physical delivery. That's 64.7 million ounces of silver that contract holders demanded in actual metal. 5 times the typical delivery month. 5 times. There wasn't enough registered silver to cover it comfortably. Total registered inventory stood at 105 million ounces going into January. But 64.7 million ounces demanded delivery. That's 62% of registered inventory in a single month. The shorts were cornered. They needed to shake out the longs. They needed to trigger margin calls. They needed weak hands to fold. Then Thursday happened. CME raised margins for the second time in 3 weeks. Friday the 31st, the last trading day of January, price smashed 31.4% in one session. Margin calls triggered across every brokerage. Leverage long positions were liquidated by the thousands. Open interest collapsed as contracts were force closed. And the shorts, they covered into the liquidation. They bought back their positions at $72 instead of $120. Convenient timing. This is the exact same playbook from 2011. In April-May 2011, silver ran from $8 to nearly $50. Then CME raised margins 5 times in 8 days. 5 margin hikes, 8 days. Silver crashed 30% in a week. The bull market ended. This is the exact same playbook from 1980. The Hunt brothers had accumulated a massive silver position. COMEX changed the rules to liquidation only, meaning you could only sell, not buy. Silver crashed 50% on Silver Thursday. The Hunt brothers were bankrupted. JP Morgan was fined $920 million in 2020 for precisely this type of precious metals manipulation. That's not conspiracy theory. That's Department of Justice settlement documents, public record. They paid the fine. They admitted no wrongdoing. And they kept trading. The playbook hasn't changed. The scale has. They're shorting into a structural shortage. Every dollar they push the price down, the Shanghai premium expands. Every ounce they short on paper, the physical market absorbs and demands delivery. Every raid they conduct, Asian buyers step in harder. This is a losing trade on a long enough timeline, and the timeline is getting shorter. Now here's the part most people are missing, what the bounce tells us about what comes next. Silver bounced 16% from $72.73 to $84.34 in 34 days. That's not a dead cat bounce. That's not a relief rally before the next leg down. That's the physical market fighting back. The bounce was driven by 3 forces working simultaneously. First, short covering. The bears who shorted silver at $120 and rode it down to $72 took profits. They bought back their positions. That buying pressure lifted the market. Second, physical buying accelerating at discount prices. Shanghai premiums remained elevated throughout the entire recovery period. That means Chinese buyers didn't stop accumulating just because the price bounced. They kept buying. They're not trading the chart. They're securing metal. Third, speculator exhaustion. This is the most important signal and almost nobody is talking about it. The latest COTI report shows large speculator gross longs at a 13-year low. Let me repeat that. 13-year low, the lowest long positioning since 2013. Gross shorts are also at a 13-year low. Both longs and shorts have largely abandoned silver futures. The paper traders have left the building. This is not a speculator-driven market anymore. This is physical demand meeting paper exhaustion. When speculators are gone and physical demand is still draining vaults, what do you think happens next? The last time silver bounced this aggressively after a crash was March 2020. COVID hit. Silver crashed to $12. Everyone panicked. Then it bounced and bounced and kept going. Silver went from $12 to $30 within 18 months. And that's a 150% gain. The bounce is the market telling you something. It's telling you the crash was artificial. It's telling you the real price discovery is happening in Shanghai at $90, not in New York at $72. It's telling you the paper market is losing control of the narrative. But let me be honest about the risks, because balance matters and I won't sugarcoat what could happen short term. Let me be clear about the short term risks. They're real. Silver is currently trading at $84.34. That's just below the 50-day moving average at $85.79. Trading below your 50-day moving average is a bearish signal in the near term. It means momentum is not yet confirmed to the upside. If silver closes below $78 on a daily basis, the technical picture opens a path back towards $72. And if $72 breaks on a retest, we could see $66 to $68, the pre-crash consolidation zone. The deleveraging is real. The margin calls were real. The forced liquidations were real. Leveraged longs got destroyed. Weak hands are gone. But that also means the next wave of buyers may wait for lower prices before stepping in. If broader risk-off sentiment continues, if equities keep selling, if the dollar strengthens further, if treasury yields spike, silver could get dragged lower despite strong physical fundamentals. The paper manipulation could continue if no external catalyst shifts the macro picture. The banks have deep pockets. They have regulatory tolerance. They've paid their fines and kept playing. If you're trading on leverage in this environment, this volatility will destroy you. A 40% crash followed by a 16% bounce is not a market for margin positions. It's not a market for 10x leverage. It's not a market for gambling. I'm not here to pump. I'm not here to tell you everything is fine and silver is going to $500 next week. I'm here to give you the complete picture. Both sides. The risks and the opportunities. Physical holders playing the long game operate on a different timeline than leverage traders. That's the reality. But here's why none of that changes the structural picture. And this is what the paper market can't fake forever. None of the short-term risks change the structural deficit. Shanghai premium at $6 to $7 currently, and $23 at the crash peak, is not weak demand. That's desperate demand. Buyers were paying 29% above paper price to secure physical metal during the crash. They weren't scared. They were buying. COMEX registered inventory now stands at 81.73 million ounces. That's down 22.3 million ounces in 30 days alone, a 20.7% drain in 1 month. At current drain rates, that's roughly 88 trading days of supply remaining. 80 trading days. 4 months. Then what? The COMEX stress index sits at 81 out of 100, the highest stress reading in years. Paper leverage stands at 6.9 times registered silver. There are 567 million paper ounces in open interest. That's claims on silver, not actual silver. Backed by only 81 million registered ounces of real metal. The coverage ratio is 14.4%. Historically, anything below 15% is rare. It signals stress. It signals that the paper claims cannot be fully backed. Total COMEX inventory is 75% lower than the 2020 peak. 3/4 of the silver is gone. And demand is accelerating, not slowing. The gold-silver ratio at 61 to 1 against a mining ratio of 1 to 8 is screaming undervaluation. When this ratio compresses back toward 46 to 1, like it was at the January peak, silver outperforms gold by 35% from current levels. That's not speculation, that's math. Bank of America sees silver between $135 and $309 by year end. Citi issued a $150 target before the crash and hasn't withdrawn it. JP Morgan's own forecast of $81 average for 2026 has already been exceeded. Silver is trading above their target. The structural deficit is not a theory. It's not a narrative. It's not a YouTube story. It's math. Supply minus demand equals deficit. And the deficit is growing. The direction is clear. The timing is the only question. So here's where we stand. 3 key takeaways and we're out. Number 1, the 40% crash was a leverage unwind and paper liquidation event, not a fundamental breakdown. CME raised margins twice in 3 weeks. The crash happened on the last trading day of the month with a weekend lockout. This wasn't real metal being sold. This was derivatives leverage being unwound through calculated margin squeezes. The same playbook as 2011, the same playbook as 1980. Documented, repeated, effective in the short term. Number 2, the physical paper disconnect reached an all-time extreme. Shanghai maintained a $23 premium during the crash, 29% above COMEX. COMEX drained 23 million registered ounces in 5 weeks while price was falling. The bounce confirmed physical demand is overwhelming paper selling pressure. The paper market is lying about the real price of silver. The physical market is telling the truth. Number 3, Watch $78 as short-term support and the 50-day moving average at 85.79 as immediate resistance. Watch the Shanghai premium direction. If it stays elevated or expands, that's confirmation of physical tightness. Watch COMEX registered inventory, currently at 81.73 million ounces, with 80 trading days of supply at current drain rates. If premiums stay elevated and vaults keep draining, the math becomes undeniable. Something has to give. The unresolved question is this. Does the $70-80 support hold and silver reclaim the 50-day moving average, confirming the physical market is taking control? Or do we see one more shakeout towards $72 or even lower before the real move higher begins? Either way, the paper physical divergence has never been wider. A $23 Shanghai premium during the crash was not noise, it was signal. 23 million ounces draining from registered vaults while paper price crashed is not coincidence, it's accumulation. Speculators at 13-year low participation means the paper games are running out of players. The futures market is emptying out. Something has to give. And when it gives, it won't be gradual. It will be violent, just like this crash was violent. The pendulum swings both ways. Tell me what you're expecting in the comments. Bounce from here? One more flush to 72? Or do we rip straight through $90? I want to know what you're seeing in your analysis. Do your own due diligence. Understand the risks. This is not financial advice. If this video added value to your understanding of the silver market, share it with one person who needs truth over noise, one person who's confused about what just happened, one person who's scared, one person who needs data instead of hype. That's how we grow this community, one informed mind at a time. Invest with logic, not hype. The Market Cipher out.